So in this video, we will be seeing in brief about the mutual funds. We will be covering topics like benefits of mutual funds, what is net asset value, the risks involved in the mutual funds, different types of mutual funds, based on the objective as well as based on the flexibility involved, and different investment plans available under the mutual funds. And what is active fund style management of mutual fund and passive fund style management of mutual fund. So all these things we will see. So now let's start. So as far as India is concerned, SEBI is the regulatory body for all the mutual funds. All the mutual funds must get registered with the SEBI, Securities and Exchange Board of India. So now let's see our first topic, which I mentioned before. That is the benefits. What are all the benefits we will get for investing in mutual funds? I would say first, mutual funds needs very small investments. Okay, mutual funds helps you to reach the benefit of the returns by a portfolio which is spread across a wide spectrum of companies with only little investments. Whereas if you do the same thing in buying equity stocks, let's say like I want to make a portfolio by buying equity stocks, then I should have lots of money, a lot of money to buy so much in stocks of different maybe business background to create a diversified portfolio. But that is not the case in the case of mutual funds, because already a mutual fund is of such setup. What you need is only a small investment. Next thing is, it is actually professionally managed fund. That's one of the great advantage of mutual fund. You don't have to have any idea about managing a stock by knowing the company or the fundamental analysis. All those things you don't have to do. Everything is done by the professionals for you, who are having considerable expertise, experiences, as well as they have the resources, and they manage the pool of money collected. Okay, what they do is they do thorough analysis of the market as well as the economy for you to pick the good investment opportunities. So you're saved from doing all those analysis. And third is, the risk is widely spread. Okay, in this case, I invested with the limited funds. Might be able to invest only in one or two stocks if it is a stock market, or if you are going to buy a stock instrument. So thereby its risk will be increased. But as I said already, in the small investment, okay, in the mutual fund, you need only little money to invest in a mutual fund which is already a diversified portfolio, and also the risk is widely spread, because a range of companies will be present, a range of industries will be present. So in the case, that's how the spread of risk is diversified. And next thing we can see is the transparency. So transparency, as I said, like mutual funds regularly provide investors with the information on the value of their investments. Also, these mutual funds provide the company the complete portfolio disclosure of the investments made by various schemes, and also the proportion invested in each asset type. So since this disclosure is there, there is a good amount of transparency in the mutual fund also. And also it gives you a lot of choice. It's not like no, already a portfolio is there, so you have to just put the money in the portfolio just decided by the fund managers. The fund managers make it more flexible by giving us choice. They You can maybe choose a choice which is according to your risk appetite, or according to your return appetite, whatever it is. So there is some choice also in the mutual funds. So as far as the regulations is concerned, as I already told, mutual funds are regulated by SEBI. Any portfolio or any mutual fund that is being set up must get registered with SEBI, and that is mainly to protect the interest of the investors. Now let's see what is called the net asset value. So net asset value of a fund. Usually every mutual fund will be having something called net asset value. How to measure this net asset value? Net asset value, to measure we need three things. First of all, what are all the assets present inside the fund? Okay, you must get the value of the assets, and then what you need to do is also the liabilities involved in these assets. So now you get the value of the liabilities. Third thing you need is the number of, okay, units outstanding. How many funds of this type are being subscribed? Like how many investors are actually subscribed to this fund? So thereby we get the number of units outstanding. Once we get all these things, now it is easy to calculate the net asset value of the fund. So what you have to do is you have to subtract 1 minus 2 and divide it by 3. So by doing this you will get the per unit value of the fund, and that's how we calculate. Okay, let's say, and that's how we calculate NAV. And let's say like the value of the assets is 100 crore and the liability is, let's say, um, liability, let's say it is 5 crore, and the number of units outstanding is, let's say, um, 95 crore. Then it is very simple: 100 minus by 95 crore upon 95. Then the value of each fund is 1 rupees. This is a very crude example, and this is how we calculate the net asset value of the mutual fund. So net asset value of the mutual fund usually are published in the newspapers. The net asset value of the open end scheme should be disclosed on a daily basis. We'll see what is this open and close in detail. And also it will be actually disclosed by the any mutual fund. So before being subscribed to, this is one of the important metric that one need to see before investing in the mutual fund. So are there any risks? Okay, any risks involved in the mutual fund? So the thing is, mutual funds do not provide, okay, assured returns to the investors. The returns are linked to the performance of the portfolio involved. So they invest in shares, debentures, bonds, etc. All these investments involve an element of risk. The unit value may vary depending upon the performance of the company. Okay, and if a company defaults in payment, okay, then the portfolio, okay, will get affected. Okay, portfolio returns will get affected. Okay, so that's the reason why, okay, it doesn't give any assured returns, because it depends upon many factors to give, okay, this assured returns. Besides, let's say like when there is any sudden downturn in the industry, or any, okay, Brexit happening, or exit any okay kind of financial crisis happening, then it definitely impacts the returns of the portfolio. So let's see some of the risks that is commonly present in the mutual fund. One is the market risk. So actually, if the overall stock market falls on account of overall economic factors, then the value of the stock, okay, will fall. So if the value of the stock falls, when these stocks are present in the portfolio, then it does impact the portfolio value as well, and thereby impacting the fund performance. And second risk is non-market risk. What are non-market risks? Let's say like a bad news about a particular industry or a company can pull down the entire stock price, which can negatively affect the fund holdings. And again, if the fund holdings, however, this risk can be averted by diversifying, okay, by choosing stocks of different companies from different industries. And then we have interest rate risk. Interest rate risk, usually, we know that, okay, bond price and the interest rates are negatively, or okay, inversely proportional. They move in opposite. They move in, okay, opposite directions. Let's say when the interest rates rise, the bond price fall, and if this happens, then what happens is, if the bond price falls, then this decline in the underlying securities affects the fund negatively. So ultimately, the portfolio's performance will get affected. And the final risk that I want to share with you is a credit risk. Say like our mutual fund is containing bonds. Okay, bonds are all already debt obligations. So in this case, what happens is when the funds invest in corporate bonds, they run the risk of corporate defaulting on their interest. When the corporate defaults on the interest, then we have credit risk. So when the risk okay gets magnified, it leads to a fall in the value of the bond, causing the portfolio to get affected. Also, the causing the NAV of the fund to take a beating. So hence, okay, these many risks, okay, makes us very clear that there is no assured risk, so no assured returns in the mutual funds. So what are all the different types of mutual funds we have? That's our next topic of discussion. Different types of mutual funds. So mutual funds are classified on the following manner. I said we can okay classify it on the basis of objectives and then the basis of flexibility. First, let's see how it is classified on the basis of objectives. You can say a mutual fund as equity fund or some growth funds. The funds that invest in equity shares are called equity funds. Okay, they carry the important objective of capital appreciation of the investment over medium to long term. They're best suited for investors who are seeking capital appreciation. So usually this equity funds will have capital appreciation. Okay, and there are different types of equity funds. Like we have okay, diversified funds. So in the case of diversified funds, the funds invest in companies that are spread across sectors. As the name diversified says, it okay spreads across sectors. So the funds are generally meant for risk-averse investors who wants a diversified portfolio across sectors. And second, I would say is the sector funds. Now, simply put, okay, it's not actually diversified about different sectors, but here it is only one sector. Maybe it may be a FMCG sector, or it may be a capital goods sector, or it may be a bank sector or IT sector. Only one sector actually the funds will be invested. So these funds are targeted at investors who are bullish or fancy the prospects of a particular sector. And another type of equity fund is index funds. So these funds invest in the same pattern as popular market indices like S&P, CNX Nifty, CNX okay, 500 or Sensex, S&P BSE 500. So it just invests in one of these indices. The entire fund will invest in one of the indices. The money collected from investors is invested in the stocks that is representing this index. So, for example, if you take the Nifty stock, it will be invested in the only in the Nifty's 50 stocks which is available. The objective of such funds is not to beat the market, but to give a return that is okay equivalent to the market returns. And apart from this equity fund, we have other types of funds as well, like tax saving funds. So if you take the tax saving funds, usually it offers tax benefits to the investors under the Income Tax Act. The opportunities provided under this scheme or in the form of tax rebates mostly. And then we have debt or income funds. So in this case, what happens is it invests the mutual fund manager invests the funds of the investor predominantly in the high rated, that is high credit rated, let's say like AAA rated uh, fixed income bearing instruments like bonds, debentures, common securities, commercial paper, and money market instruments. They are mostly suited for medium to long term investors who are risk averse as well as they seek capital preservation. They provide a regular income to the investors. And now let's see a few more things under this. So based on the objective, one can also invest on liquid funds. So liquid funds are usually high liquid market instruments. So if the funds are invested in high liquid market instruments, then it is liquid, okay, funds. The period of investment could be as short as a day. It can be very short as a day. They have emerged as an alternate for savings and short-term fixed deposits, usually with comparatively higher returns. So mostly, only corporates and institutional investors can avail this type of liquidity funds. And then we have something called gilt funds. So what are these gilt funds? So gilt funds, as the name says, like, yeah, it is government-based funds. The funds will be invested in the central and the state government securities. Since they are government-backed bonds, they give a secured return and also ensure a safety of the principal amount. They are best suited for the medium to long-term investors who are averse to risk. And then we have balanced funds. So balanced funds will be having a mix of debt and equity. A mix of debt and equity will be there. So in the case of balanced funds, uh, it gives a steady return and it reduces the volatility of the fund while providing some upside for capital appreciation. Okay, also they are no, medium to long term funds. This is good. And now let's see on the basis of flexibility what's going to happen on the different types of the mutual funds. So on the basis of flexibility, one could say we have open-ended funds. What are open-ended funds? So open-ended funds are the funds that do not have any fixed date of redemption. That means there is no any particular date for maturity. And another thing is they are actually open for subscription throughout the year. And the prices are actually linked to the daily net asset value. Actually, they are more liquid from the investor's perspective. Okay, because you can redeem it any day and you can buy it any day. So in that way, it is better. And next we have something called close-ended funds. So usually in the close-ended funds, the funds are usually open for entry during the IPO only, open only during the IPO, and then it will be closed for the entry as well as exit. The funds have a fixed date for redemption. It's a very important thing. There's a fixed date for redemption. So you cannot sell it at any time you want, or you can buy it at any time you want. One of the characteristics of the closed-ended schemes is that they are generally traded at a discount to NAV. Hey, yes, there's one important attractive feature of this closed-ended fund is they're generally traded at a discount to the NAV. Okay, that's important thing. Net asset value is traded at a discount to NAV, and at the time of redemption, you will get the full face value. But however, this discount narrows as it reaches the maturity. Uh, these funds are open for subscription only once and can be redeemed only on the fixed date of redemption. The unit of these funds are listed on the stock exchanges and are tradable, and the subscribers to the fund would be able to exit from the fund at any time to the secondary market. And now let's see what are all the different investment plans that the mutual fund offers. So let's see the different investment plans. So first one I would say is the growth plan. In the growth plan, what happens is it's a plan wherein the returns from the investments are reinvested. Returns are reinvested. Okay, and very few income distributions will happen. In the case of dividend plan, what happens is the income is distributed from time to time. There is no reinvestment happening here. Whatever income is there, it will be redistributed from time to time. But there is something called dividend reinvestment plan. So in this case, there is some amount of capital appreciation possible. Okay, uh, and also there is some amount of income will be reinvested. So it's a mix of both growth and dividend. And under this plan, the dividends declared by a fund are reinvested in the scheme on the behalf of the investor, thus increasing the number of units held by the investors. And now let's see about something called fund offer document. What is this fund offer document? A offer document is a document that offers you all the information, okay, as much as possible. You need to know about a particular scheme, and then also it in a way it saves you taking any significant risk without knowing about anything. We cannot invest in a stock, right? In the same way, to know about a mutual fund, you have to go through the fund offer document. In the stocks, we had prospectus. In the mutual fund, we have something called fund offer document. So obviously, this fund offer document has to be designed according to the guidelines set by SCBI, and the prospectus must disclose details about the investment objective. Okay, what are all the expenses that is going to happen in the case of this investment fund, and what are all the risk factors that are there, and also it should say the organization of the capital structure, tax provisions, and the financial information. So much it will be disclosed in the fund offer document to the investors. Now it's time to see about the active fund management. What is this active fund management? So what is this active fund management? When the investment decisions of a company is actively being managed by the fund manager. That is what active fund management is. So what happens is daily the active fund manager will will invest based on research, analysis, market news. The also if buys and sells securities based on the changed perceptions of investments from time to time. So it will be managed time to time. That's a very important thing. Um, the and also based on the classifications of the shares with the characteristics, active managers construct different portfolio. However, in the active management, we have two different styles, I would say. One is the growth investing, another one is the value investing. So we already seen this type of investing style in the case of stocks itself. The same concept applies here. The primary objective of the any equity investment is to obtain capital appreciation, right? So a growth manager looks for such companies who which is actually expected to give above average earnings growth. The manager feels that the earning prospects as well as the stock price in the future will be higher in the case of the growth funds. It's a very challenging task, however. And another one is value investment style. He actually looks to buy companies that are now undervalued or overlooked upon by many fund managers, but however is worth uh, will be recognized in the market eventually. So those type of fund management are called value management. Uh, then we have something called okay, passive fund management style. So in the case of passive fund management, the investors, instead of okay investing in actively managed funds, wherein okay active the fund manager will be daily doing the analysis, and then okay you will be bringing forth a good amount of returns to the investors. But however, it is not always the case. Sometimes the decisions may be right, sometimes the decision might go wrong. So it can lead to substantial losses for the investors as well. So that type of thing is present, that type of risk is present in the case of active fund management. So what happens in the case of passive fund management is uh, they are mostly index funds. Put there is no manager who will be doing okay all those analysis that I said, but it will be index funds, let's say like Nifty index funds. Its objective is to equal the return of the selected market index. That's it. Nothing more and nothing less. Okay. Um, Such funds allow a passive investment style. They do not analyze any companies, markets, economic factors, and then okay narrow down on stocks to invest in. Nothing will be done. They will just prefer to invest in a portfolio of stocks that reflect a particular market index. Maybe from Nifty 50, they will select some okay let's say like some few stocks, and they will invest in these stocks to reflect the returns as of the Nifty 50. Okay, the returns generated by the index are the returns generated by the fund. No attempt is made to try and beat the index. So, but however, if you see the case of okay active as well as passive management style, the research has shown that most of the fund managers are unable to constantly beat the active fund management, wherein okay there will be the market, right? That is not at all happening year after year, and also it is impossible to identify fund which will beat the market index. Correct. So going by this okay factor, passive fund management style has gained okay popularity. So funds this okay index funds also at the same time it is diversified, right? Because it represents a huge amount of stocks of different okay business sector and different companies and industries. So that is not, however okay um, it however okay it is diversified at the same time it is also not expensive. So that's the reason why it is very popular. So by spending less, okay, you can have your funds diversified, and also you can get the returns as that of the returns of the index with the less fund involved. But there is another okay financial instrument that is not actually a mutual fund. Uh, it's called ETF. ETF is separate from the mutual funds. It is like an exchange traded fund. So this is not actually managed by any intermediaries. It is like a stock. It behaves like a stock, and it is sold in the stock exchange or in the stock market. Um, but this ETF represents a basket of stocks. It's like a mutual fund, but it is not a mutual fund. Okay, it represents a basket of stocks. So again, this stocks, this ETF stock has its own okay NAV, but this NAV is calculated not as we calculate in the case of mutual funds. This is purely based on the market forces. It's the demand and the supply factor. That actually tells the price of this ETF. And it is important to remember that the ETF's attempt to replicate the return on an index is not guaranteed. So sometimes okay it may behave in a different way, wherein okay the index returns will go up, the ETF return may go down, but mostly the ETF returns are like the returns of the index it is representing. Okay, maybe we will be having a oil ETF that will represent only, okay, the basket of oil-based companies written that way. So by owning a ETF, there are again, okay, many advantages. You get the diversification. The reason is it represents a basket of, okay, stocks, right? So we get the diversification. Another advantage is the expense is very less than the mutual fund. So another important thing is the brokerage charges is same as that of the stock. In that way also the expense is very less. So if you could ask, okay, between, okay, ETF, mutual fund and stock, it is the ETF that scores above these two. Reason is simply because it is diversified and it is having less expense and it involves the same brokerage costs as that of the stock. So that's it as far as this video is concerned, and thank you for watching this.